A series of highly unusual events has unfolded on Wall Street over the past fortnight as three of the world's largest financial titans encounter a shared struggle. Investors want their money back, but the gates are closing. BlackRock, Blackstone, and Blue Owl Capital have all recently signaled that liquidity is becoming increasingly scarce within their private credit vehicles. BlackRock, which manages over $11 trillion in total assets, recently received $12 billion in redemption requests from its investors. However, the firm announced it could only fulfill half of that amount, providing $6 billion while citing fund rules that limit quarterly redemptions to 5% of total assets. The situation at Blackstone has prompted even more drastic measures. Facing redemption requests that exceeded regulatory limits, the firm took the rare step of having its own leadership intervene. The company committed $400 million of its own capital, while 150 senior executives contributed an additional $150 million from their personal funds to purchase shares in their own fund. This move, reminiscent of a bank manager placing their own cash on the counter to calm a crowd during a bank run, was designed to maintain stability and prevent panic. Meanwhile, Blue Owl Capital took the most direct approach by simply canceling its redemption window entirely, asserting that the firm would decide when capital is returned rather than the investors. The root of this systemic tension lies in the private credit market. Over the last decade, as traditional bank regulations tightened, Wall Street created a massive alternative lending business. These funds gather cash from investors and lend it to corporations that banks are no longer willing to service, offering high annual returns ranging from 8 to 12%. The fundamental flaw in this design is a maturity mismatch. The underlying loans typically last 5 to 7 years, yet investors are promised they can withdraw their money every quarter. In a stable market, this imbalance is manageable, but as confidence wavers, the gap between short-term expectations and long-term reality becomes a chasm. Two primary factors are driving the current rush for the exits. First, recent scandals involving fraudulent loan applications have shaken investor trust. Second, and more importantly, the rise of artificial intelligence is threatening the solvency of the software industry, which accounts for roughly 1/4 of all private credit borrowing. Many companies are finding that expensive legacy software suites can now be replaced by artificial intelligence tools at 1/10 of the cost. If the revenues of these software companies continue to decline, their ability to repay these massive long-term loans disappears. While the current scale of the private credit market is approximately $2 trillion, significantly smaller than the $10 trillion housing market that triggered the crisis in 2008, the cracks are widening. Financial analysts are now monitoring three critical indicators: whether redemption requests will continue to climb in the next quarter, if new financing for private credit will stall, and if software companies will begin to default on their obligations. For now, the gates remain narrowed, serving as a stark reminder of an old financial adage. Money is only truly liquid until the day everyone decides they actually want to hold it.